really has still been downtrending, all things put together, since the high watermark comment. But this morning it seems investors are just kind of nonplussed by this. There's not much going on. Tell me why.
Right, yeah, I think you got it right on the head there. I mean, we didn't get a ton of information, frankly. I mean, the results in the first quarter were pretty much in line with my model. A little bit of puts and takes here and there, zero forecast going forward. So we really don't have much of an idea what to expect. So I'm not surprised the stock is kind of flattish here, just really no new information.
Seems they confirmed what many of us expect, that the economic numbers for the second quarter will probably be significantly worse than the first. Those were literally the words, more significantly impacted. Caterpillar says next quarter. In terms of guidance, we kind of know that a lot of these companies aren't able to give great guidance. So how do you know what to expect? I mean, how do you model them going forward?
Yeah, I would have to say, as a sell-side analyst, this is one of the most uncertain times I can remember. I've been doing it back since the late 90s. So to your point, it is a tough one. But I would say we do have some things, obviously, we can look at. They do report monthly retail sales. That number came out this morning as well. Those continue to decelerate, not surprisingly. We also know that the company is working to reduce its own and dealer inventories as well. And so we kind of have a sense of what type of underproduction we should be looking for. And then CAT, like a lot of industrial companies, has historically targeted what we call decremental margins, just the decline in operating income per dollar of decline in sales, and they've been targeting that sort of in the 25-30 range, but we all sort of know that when things are down precipitously, it might go a little higher than that. So those are some of the moving pieces that we try to use to look at kind of the next couple of quarters.
In terms of those inventories, does that mean right now we shouldn't expect Caterpillar to have a bunch of machinery sitting around in lots and over inventoried? Is that going to be a problem for them, or have they been able to at least understand that this isn't a great environment, so they don't need to produce a bunch of stuff?
Yeah, I think the latter. I mean, to be fair, I think we do have a fair amount of stuff sitting on lots, and that's one of the reasons that they're going to be producing less than the dealers actually need in the second and probably the third quarters as well. So, that means that whatever the market's demanding, they're going to be producing even a little bit less than that, and obviously that'll impact their numbers short term. It's a great thing longer term, because when things do start to get better, they can respond quickly. And of course, if you don't have a ton of inventory, you probably don't have to mark it all down, which is also nice. But in the near term, it can hurt.
If there is a strong bounce back, estimates continue to be for a decent quarter on the other side of the worst coronavirus impact. If you look at most of the estimates, we're looking at a global jump after a big decline in the second quarter. Is Caterpillar prepared for something like that? Is that the least of their issues right now, having too much demand? Is this more skewed towards them being prepared for a slower grind back to normal?
Yeah, I think you get that right. I mean, CAT has some very specific end market challenges here, which makes it a little bit surprising that the stock has bounced so hard off of recent bottoms. But as I'm sure you and your listeners probably know well, I mean, they have three major areas where they do business: construction equipment. And certainly, I think most of us are not looking for a huge recovery in commercial construction. There's going to be good chunks of that are probably going to take maybe even several years to recover, things like hotels and office buildings and airports, et cetera. I think we'd expect those to be slower going forward. And obviously, CAT's also exposed to mining, and you've probably seen mine come up. Mine CapEx estimates are coming down fairly meaningfully as we speak this earnings season. And then the final piece of the pie is oil and gas. And again, I don't have to probably talk too much about that, but the key end markets here are not particularly in CAT's favor, I think, over the near and potentially even the medium term.
Right now, the energy and transport segment with machinery down 40%, still a little bit above some of the estimates on a median basis, but obviously huge declines. They did discuss a little bit about potential China pickup. Will that be indicator as to where the overall market for their products goes? Can we get a sense of what's happening in China as they return to some degree of normal? Is there hope there?
Yeah, I think we're all looking to China to see what a gradual reopening could look like, and so we're hearing across the industrials that things are improving a bit in China. That's great. By and large, we're hearing that the market share of the international players is actually under a little bit of pressure. So that is something we'll have to watch closely. But, for CAT overall, China sales are less than 5% of the company. It's not enough to move the needle by itself. It has to be sort of a precursor of normal recovery in places like Europe and the U.S. to really start to make a difference.
Yeah. Steve, I saw you had a hold coming into the report. Has anything changed from Caterpillar on your rating or price target?
No, it really hasn't. I mean, look, CAT's doing a great job at managing what they can, which is sort of their internal cash flows and costs and so forth. So obviously a high-quality, long-term type of a company. But I went through some of the what looked like somewhat impaired end markets just a second ago. And again, there wasn't a lot of new information on the quarter here that I think probably changes people's minds much.
Yeah, all right. Steve Volkmann, Managing Director at Jefferies. Thanks for the update here on earnings. We're going to do a little trading here with Tom White. Tom, come on into the conversation. The hold rating from Steve here. How do you go about trading Caterpillar within a range? Even after earnings, can you get some premium through volatility to sell outsized moves on the stock? How do you go about that?
Well, I came up with a couple different strategies, Oliver, to take advantage of it. We still have high implied volatility if you look at this at Caterpillar and the overall market on a historical basis. So you still have some elevated volatility. How do you play this? If you're doing something a little bit more neutral, the first strategy that comes to mind is maybe an short iron condor, where you're selling out of the money put vertical and an out of the money call vertical. So you collect a credit on that, and then you have a range that the stock should trade in for you to potentially profit on an option strategy. And the example that I looked at first was the May 22nd weekly series. So you've got about 24 days until expiration. So really short-term trade. And that's selling the 108, 110 put vertical. So you sell the 110 put, buy the 108 put to make it risk defined. And then on the upside, you sell the 121, 124 call vertical. So short $2 wide put vertical, short $3 wide call vertical to the upside. Now, if you can collect about $1.50 credit on something like this, that takes your break even on the downside down to about 107.5. And then on the upside, because you got a short $3 wide call vertical on the 121, 124, your break even is going to be about 122.5 over the next 3.5 weeks or so. But this is a way to take advantage of time decay, or theta, where the price of this short iron condor, as long as it stays between those break evens, is going to decay at a daily rate. And the idea is you sell this for $1.50, you buy it back for 75 cents or 50 cents, or you let it go out worthless at expiration. So that's a way to take advantage of a relatively neutral stance where it's not going to go above that 122.5 or below 108.5.
I had a feeling we were selling some condors here. I just had a feeling, Tom. So is this the best way to do it then, when you have volatility that's still elevated in the market? Basically, you're selling against somebody who's betting on a big swing, so you're contained in your range where you can make money. You want the stock to remain in a range. What else can you do? I mean, can you buy just in the money options if you just want to watch it kind of grind higher? I mean, what's another way to say, to express a view that there's not a big move coming?
Well, the next strategy I looked at is still a short iron condor, but it's a little bit different setup here, Oliver. And that's where I went out to the May series. So you've got about only 17 days until expiration. And you still want to take advantage of a range-bound type of trade, take advantage of time decay or theta on this, where it decreases in value every day. And what I looked at was selling the 115 straddle in that May series. So you're selling the call and selling the put. You collect a credit on that. And then to make it risk defined, you buy the 110 put to the downside and the 121 strike call to the upside. So it's still an iron condor, but What it is, it's got a common body strike at that 115 level, and this turns it into basically an iron butterfly is what we like to call it, because the risk profile sets up that way, where you need it to stay. If you can collect about $4.30 on this, Oliver, the short put vertical, the 115, 110s, $5 wide, you collect 430, you got $70 per spread risk to the downside. That's it. And then on the upside, the setup was a $6 wide short call vertical where you sell the 115s by the 121s, and that takes your break even up to about 119.30 to the upside. And you've got a little bit more risk on that upside. You collect 430. It's a $6 wide short call vertical, so you've got a little bit more risk on that, about $1.70 on that to the upside. But this takes advantage of time decay, implied volatility coming down in the name. If you get that stabilization that you want, that'll also help this type of trade, because you're collecting a credit on it, and your risk is the width of the verticals. And in this case, the widest vertical is $6 wide minus that $4.30 that you collected. So you got about $1.70 risk to the upside and only $70 to the downside in case it does start to fall. But this takes advantage of a range-bound scenario also on that, but a short-term trade.